Hey guys, this is Colin Nathan Alim, the real estate boy. And today we have a great episode. All right. This is the real estate episode. So, welcome to the Real Estate with Soul, the podcast where we explore the heart and soul of the real estate industry. I'm your host, Colin Nathan Alim, the real estate boy, and together we'll be diving into the stories and experiences of professionals who are dedicated to serving underserved communities in the real estate industry. Whether you're a real estate professional, a home buyer, or simply interested in the real estate industry, this show is for you. So, join us as we dive into the world of real estate with soul. Now, today I was supposed to have a lender on here, but maybe he ran into some problems. So what we're going to talk about today, okay, are the 10 things that your lender should know. Okay, these are 10 things that your lender should know. All right. So my lender partner was supposed to come on, but like I said, I think he's having technical difficulties. But I've been in a lot of transactions, okay? A lot of transactions. So a lot of these answers I do know, but I wanted to get y'all again a resident mortgage consultant expert on here to ask these questions so you guys can know what's the best way to handle getting to the money. All right. Because at the end of the day, what do you want to do? Y'all want to get to the money so you can get the house. All right. Y'all want to get to the money to get the house. Now, I do have to let you guys know that on March 9th, which is under 2 weeks now, okay, we have the Ultimate Home Buying Masterclass, the Ultimate Home Buying Masterclass. So if you go to www.buyinginphilly.com, you'll be able to get a ticket free of charge, okay? You're going to get a wealth of knowledge. You're going to get the entire home buying process, and you're going to get it from the expert in each field, okay? It's not going to be just me up there talking or the lender up there talking. No, this in this masterclass, I got from each step, I got the residential expert to come and talk to you guys. Okay, so it's in Philadelphia. If you're not in Philadelphia, or if you're in Philadelphia, New Jersey, or Delaware, you should definitely come through. Okay, so again, today what we're doing is 10 questions, all right, or 10 things that your lender should know. Okay, your lender should know. All right, but before you do that, make sure you guys go and you sign up for this Ultimate Home Buyer Masterclass. Everybody that signs up for the Home Buyer Masterclass, when they leave, they're going to get a customized home buying blueprint. A customized home buying blueprint. Okay. So you guys definitely want to make sure you're in the building. Tickets are going super duper fast. It's free of charge. Okay. It's free of charge. If you're looking to buy a home this year or next year, and whether you're a first time home buyer or you're a seasoned home buyer, it doesn't matter. We got, what was this? I've been on the one for your email since, oh man, he's on here. Um, but it doesn't seem, um, use the one I just gave you. Use the one I just text you. There he goes. All right, let me pull him on in. Alex.
Yes, sir.
Hey, yes. It was probably my fault. I probably sent you the wrong link, man. But I'm glad you were able to fumble around with it and get it to work, man. Appreciate that.
Absolutely. Thanks for having me on.
No problem, man. As I said before, these are the 10 questions that your lender should know. Okay, I'm trying to make this look a little bit better, but as always on here, I'm probably having technical difficulties with this also. I don't see where my background is, but that's okay. We're gonna rock and roll with this, man. So, just to introduce Alex, Alex is a mortgage consultant with Prosperity Home Mortgage. Okay, Alex, why don't you tell me a little bit about yourself?
Yeah, so I've been in this wonderful industry for over 20 years. So I've seen every possible swing in the market, both good times and bad times, unique times. So just really battled through everything that you could imagine and just, thankful to be a part of it and love every new adventure that takes place every day, to be honest.
Awesome, man. Well, listen, we're gonna jump right into it. I'll let everybody know on March 9th. is when it's going down, March 9th. We're going to have this ultimate home buying masterclass. And Monday, Tuesday, Wednesday of this week and next week, I'm going to be bringing on the individual experts in their area to talk to you guys really fast. But you definitely want to go to buyinginphilly.com and make sure you RSVP because tickets are going fast. Okay. So we're trying to get to the money. People out there, they want the money. They want the house, but they know that they need the money in order to get to the house. Um, a lot of people fumble in this process, and they fumble because they don't know certain things. So I'm going to ask Alex these 10 questions, and again, these are 10 questions that if your lender doesn't know, then you really need to be calling Alex. Okay. So the first one is Alex, what are the key factors you consider when approving someone for a mortgage?
Absolutely. So I would say the two biggest things for one is credit score, because each program has a credit score minimum. So you have to at least have that minimum in order to get a credit score. So that's number one. And the other two biggest component is something called a debt to income ratio, which really means how much monthly income are we bringing in to support any existing monthly debt plus a new proposed mortgage payment with taxes and insurance. So basically, does this person make enough money to afford what type of mortgage they're going to be taking on?
Got you. Okay. So for the people who are on TikTok and the people who are on Instagram, if you didn't hear what Alex said, is that the two biggest components, if you want, are your credit score and your debt to income ratio. And a lot of people get caught up with the debt to income ratio because they say, well, I make a ton of money. I promise you, I just had a guy this weekend. And he's like, well, what's the problem? I make a lot of money. Like, why am I only being pre-approved for $150,000? And I had to explain to him, yes, you make a lot of money, but you got a lot of debt also. And what mortgage companies do is they take those two factors and they come up with a monthly allowance. And then they back that monthly into allowance into a purchase price. Is that correct?
Yeah, that's exactly it. So it's funny when I pre-approve somebody, I ask them two important questions. What's your comfort level on a monthly payment? And how much money do we want to use for down payment and closing? And there's never a right or wrong answer to that. So based on their comfort zone for a monthly payment, I then tell them what price point they should be looking in to match where they want their payment to be. And then, of course, we make sure that their debt to income ratio is in line with what mortgage standards are to qualify for whatever that payment is.
Right, guys. So listen, number one, what Alex is saying is number one, you got to get your credit right. You got to get your credit right. You can't even cross the threshold if you don't have your credit right. Even to be looked at, your credit has to be right. That's number one. And number two is that debt to income. You can be balling out, making a lot of money, okay? But your debt has to be under a certain amount also. And remember, that's how they're going to come up with how much money you're approved for. Is taking your income and taking your debt, and there's a percentage that they can go up to use, and then they take that number times it by 12. Well, not times it by 12, but they take that number, and that's what they use in order to get your price point. All right. So the next question that we have, I hope you guys understood that. If you don't, definitely put a question in the chat. If you're on Facebook, LinkedIn, um, where else we at? TikTok, Instagram. If you have a question, definitely chime in. Okay. Number two is Alex, can you explain the different types of mortgage loans available and who they are best suited for?
Yeah, so the three major loans that exist out there are conventional loans, FHA loans, and VA loans. Okay. So we'll start with VA loans because you have to be current or have been in the military to get this type of loan. So a regular civilian wouldn't be able to get it. I think the VA loan is one of the best loans out there. You're able to do 100% financing, which means 0% down payment. So if you are a VA buyer, you just have to take into consideration what the applicable closing costs would be in that scenario. Then we go to an FHA loan, which has a minimum down payment of 3.5%. The cool part about that is that's available for 1 to 4 unit properties. So you could have somebody who's looking to buy a house all the way up to a quad and live there as a primary residence and only put 3.5% down for that particular mortgage. Now, the one thing that I like to kind of explain the difference between FHA and conventional loans, people always come to me, hey, Alex, which loan's better? Which one's for me? And it kind of is, it depends on the situation. So the things that I like to share with people are this. So with FHA loans, there's less change in interest rate as you go up and down in credit score. So, for example, if you have somebody that has like a 660 credit score versus a 760 credit score, the interest rate isn't too much different for that loan applicant. Versus if we were to do a conventional loan, the credit score has more of an impact to both the mortgage interest rate and also something called PMI, which stands for private mortgage insurance, which is required whenever you put less than 20% down. So that is more sensitive to credit scoring versus conventional. So it really depends on the down payment preference of the client, as well as what their credit profile looks like, to determine what kind of financing option probably looks like it's best suited for them.
Right. Matter of fact, I just had a client ask me today the same thing as far as, okay, what's better? And I said, that's not really a valid question as far as what's better. It depends on the person. This
Correct.
type of loan is suitable for this person, and this type of loan is suitable for this person. So you just kind of take the person's individual situation and put it to it, but don't put yourself in a box, okay? Because I've had clients come in and be like, I want an FHA loan. But hold on. Let's take your situation to a professional and see. You don't go to the doctor and be like, oh, I got a cold, I got a cold. No, you let them analyze you, and then he tells you, well, no, you got bronchitis or you got an upper respiratory infection. Okay, you may not have just a cold or you got the flu or something like that. Do you see people doing that?
So I get calls every day, same as you. So, hey, Alex, what's your rate? Well, the answer is it depends. It could be anywhere from 6% to 7.5% because there's so many factors that come into play. Like what you said, I have people that call me too and say, hey, I want an FHA loan. I say, well, why? Well, somebody told me you need minimum down. But what if a conventional loan is a better option for you? So it's kind of my job to take all the information and then do a follow up consultation with them to kind of talk through what options are best suited for their situation.
Right, excellent. And guys, Alex will be down there on March 9th. Now our office, this is in Fishtown, right?
It's actually in it's right in between Old City and Northern Liberties.
Okay.
Yeah,
Okay.
so it's actually right near 7th and Calla Hill is the major
Okay.
cross street.
Gotcha. Yep. And I told, hey, if you don't have a card, that's not an issue. Take the L, get off at Spring Garden, and just walk up. I mean, it's kind of right there. So nobody has an excuse not to be there. Again, we're going to have food, we're going to have door prizes, we're going to have raffles. Everybody's going to leave with a customized blueprint. You just need to go to www.buyinginphilly.com. Okay, go there and reserve your ticket. All right, so let's move on to the third question. The third question is, Alex, what is the process for applying for a mortgage, and what documentation does a person need?
Yeah, so I break it down into three components when I speak to a client, okay? So I tell them the first part is me just collecting all of their basic information, like their name, address, social, date of birth, what they do for a living, all those types of things. So we could take a look at the credit, which is a big indicator, again, of what kind of mortgage programs and mortgage interest rates that somebody would qualify for. The second part is we give them a list of documentation to gather together. Because at some point when it's time to put that offer in on a house, we, the lender, have to produce something called the pre-approval letter, which specifically tells the seller, hey, these guys are good to go for a mortgage. We've reviewed all of their financial paperwork and they're solid, right? And those documents are inclusive of their photo ID, the last 30 days of pay stubs, last 2 years of W-2s and tax returns, and then last 2 months of any kind of bank statements or 401k retirement if they plan on using those accounts. But then also the last part is I always ask three questions at the bottom of the email, and then two of the things I already spoke about. And one is, what's your comfort level on a monthly mortgage payment? Two is, how much money grand total do we want to use to buy the home for the down payment and closing? And then the third part is, what areas are you looking at? Because property taxes could vary quite significantly depending on the neighborhood that somebody wants to live in. And then all this information enables me to come back to you and pretty much say, hey, based on your credit and how you answered all these questions, here's the price range that I'm coming up with for you to keep your payment exactly where you want it to be with the amount of money that you plan to use. And that's why, you call it, and then the person that we're linking up here with can create a search to search for homes that not only meet their taste criteria but also fall right in line with where they wanted the numbers to be. And then what we then do is do a very detailed, in-depth conversation and kind of talk through those financing options that are most appropriate for their situation.
And that's an important question, and a lot of lenders don't ask that.
Mhm.
A lot of lenders, what happens is that they'll get the person's information and they're just giving them a pre-approval on the highest amount. Versus, and most of the time I find myself having to do that job as far as to ask them, hey, what is your comfort level? Yeah, you're approved for $500,000, but what's your comfort level? Do you want to be at $500,000, or do you, what's your payment? So that's a great question. So if you guys missed it, what Alex said is that as far as documentation, there's basically three sets of documentations, or three stages that he kind of goes through. One is the basic information where he gets your credit. Because if your credit is jacked, we're not going to step two. Okay. Step two is getting the list of documents from you, your finances, your ID, your 401ks, um, bank statements. So all of your kind of financial information. And then number three is there's three questions that he asked um, to basically customize what he's looking to give you, or customize their pre-approval, just to make sure that we're not overshooting and we're kind of getting you what you want in your comfort level. Um, so hope I recap that. Okay. Um, Number four. All right. Number four, Alex, is how do you determine the best interest rate on a mortgage, and what can they do to secure the best interest rate possible?
Yeah, so it goes back to, so the credit will be the biggest indicator to get you into the best interest rate, whether it's an FHA, VA, conventional, or different types of loan programs that are out there. The best rates will always come with the best credit scores. So
Mm.
there's so many times where, and there's credit buckets too. So like for example, like 720 credit and above is a credit bucket. So if we get somebody who's slightly under that 720 threshold, one of the things that I coach somebody on is like, hey, what can we do to get that credit score up over a 720 to get you into the next interest rate bucket? So, the credit is king when it comes to the interest rate. So I would say that's the biggest thing. The other things that people can do, and this is something that we do in our in-depth follow-up call when we do those pre-approval steps, is talk about buying down the rate too, which is essentially, I'll give you like a little comparison. So let's just pretend right now somebody qualifies for a standard 7% interest rate, right? And with that 7% interest rate comes, we'll call it regular closing costs, meaning the standard closing costs that exist to get a mortgage, right? But let's say somebody was dead set on getting a cheaper payment and having, a few resources available to come up with some extra money towards closing. What somebody could also do is called buy points, which means paying extra closing costs to get a below market interest rate. So, and this is a complete random example, but I just shared with you in that circumstance, let's just say somebody was paying 7% with regular closing costs, but if they paid like an extra $3,000 in closing costs, which are called buying points at closing, maybe they would get that interest rate all the way down to 6.5%. And that could be in a better monthly payment category for them. So they're kind of making an upfront investment at closing to get a below market interest rate, which we're seeing a lot in today's market with the rates being a little bit higher than normal.
Gotcha, gotcha. Okay. So just to reiterate, talking about how can a person get the best interest rate, and that best interest rate is going to be really predicated on your credit. And as you guys know, who've tried to kind of change your credit score, it doesn't happen overnight. Okay, it doesn't happen overnight. So that credit score is definitely going to is the biggest indicator to get a better rate. And there's also credit buckets. Okay, so They have different buckets, and if you fall below a certain credit bucket, what Alex is saying is that him and his team will try to do what they can do to get you up to that next credit bucket. So you can get a better rate. That's a strategy that they use, and they also use a strategy of buying down the rate. So you're paying more closing costs to get a lower rate. Okay, so those are some strategies that they use to get you the best interest rate possible. Um, Number five is, Alex, what are all the costs involved in obtaining a mortgage, including any hidden fees?
Yeah, so I'll break down different categories of closing costs that you'll see when you purchase a home. We'll call it in Pennsylvania, right? Because in New Jersey they're a little bit different. In Delaware they're a little bit different. In other states they're a little bit different. But in Pennsylvania you have your mortgage related costs, which usually consists of an origination fee, which is also sometimes called a processing or an underwriter fee, which then you would have your appraisal costs, which is different costs depending on the loan program that you're in. So sometimes, for example, an FHA appraisal or a VA appraisal could be a little bit more expensive than a conventional appraisal. So some of the closing costs are more subject to change depending on the program. But those particular things consist of what I call the lender fees, which that's the component that you're going to shop around if you're fee sensitive with your mortgage company. Those are the fees that you're going to want to shop around with. Aside from that, you have your title costs, which are costs that go to a title insurance company, which kind of quarterbacks the transfer of the property from seller to buyer. So it's kind of their job to change ownership interest from the seller's hands to the buyer's, but also provide something called title insurance to a buyer, which protects the buyer against any liens or judgments that could come up on the property from past owners or the current owner of the property right now. Um, Aside from that, you also have your home insurance, which is typically paid at closing, along with any property, school, municipality type taxes that people tend to often pay with their escrow account through their mortgage. But sometimes there are certain costs with that associated at the closing table. So you have your lender fees, you have your title fees, you have your tax and insurance costs, which all total kind of make up your we'll call them closing costs to purchase a home when getting a mortgage.
Okay, gotcha. And are you including the transfer taxes in there also?
Yeah, so transfer tax is something that will vary depending on the area that somebody's looking in. So, for example, Philadelphia has slightly higher transfer tax than a lot of the suburban areas outside of the city. For example, like over the bridge in New Jersey, believe it or not, buyers don't even pay for transfer tax when they purchase a home. But yeah, included into the closing costs also is a transfer tax, which in most of the state of Pennsylvania it's 1%, and again in Philly it's just over 2% paid by the buyer.
Right. Right. Okay. So just to reiterate, guys, as far as because I know some of you may be looking for, maybe price sensitive. Um, I was just talking to a fella this morning, and he was asking me about price, and I'm like, yeah, I mean, price is important, but at the end of the day, this is your biggest financial transaction that you'll probably do in your lifetime. And it's going to be something where this loan is over 30 years. So yeah, you can shop for price, but what might be more important is, number one, finding a lender that cares. That may be more important, and also the process, because what happens with a lot of lending agencies is they'll pull you in with the low costs, but you'll never make it to the table because of their process, their processes. So it's good to have, like I said, a knowledgeable lender, a lender that cares, and a lender that can get to the closing table. Because at the end of the day, your ultimate goal is to get the house, not to tell people how you beat the lender on fees, but you never got to the actual table. So you just want to be cognizant of that, but you're not getting a house for free. Okay. So there are costs. Um, you have the mortgage cost, which includes the processing fee, appraisal. Um, like Alex said, You have the title fees. You have the title fees. You have home insurance. You have transfer taxes, but you also have soft fees. Okay, soft fees that aren't in the closing costs, like your inspection. Okay, the inspection is 600 or 700 bucks. Okay, and also what they've done maybe in the last year or two is people with lower credit score, they've made the reserves more that they have to have. Can you speak to that a little bit?
Yeah, so there's you asked me a couple, a question at the beginning, which was, what are the components, what are the most important components to, get somebody like a good interest rate or a mortgage approval? And I said credit and your debt to income ratio. But let me kind of back up and say what kind of grants somebody a pre-approval on a mortgage end. So what are all the components, right? So basically, what happens is for most types of loans, a lot of the information on whether somebody gets approved or not is relatively automated. And I'll explain what that means, right? So it's my job to collect everybody's information. So we take all their information, we run their credit, we collect all of that documentation, right? So then I take a look over everything to make sure the income that they gave me matches up with what the pay stubs, and the pay stubs show me the income, and I calculate it in a fashion that adheres to either a conventional loan, an FHA loan, or a VA loan, right? So it's my job to know how an underwriter is going to calculate that when they look at it, right? So I take their income, I look at their assets, and I hit a button, right? And it goes through this
Mhm.
automated underwriting system, right? So in a very short, like 1 or 2 seconds, a computer system that every mortgage company has the same one, right? We all hit a button, and basically it takes into consideration so many factors at once, right? It takes into consideration their credit, which is credit score, credit history, credit profile as a whole. It takes into consideration something called a debt to income ratio, like we talked about before, but it also takes into consideration somebody's assets, right? So the money that they have for down payment and closing, plus something called reserves. Okay, so reserves, the layman's definition for that is the money that somebody has in the bank that's left over after they purchase the home, right? So, not all the time does somebody need reserves. So, when does somebody need reserves? So, think about what I just said, right? It's a matter of credit, debt to income ratio, and assets, right? So, where somebody may be lacking with credit score or having a higher debt to income ratio, maybe that person needs extra money to be in their bank account after they purchase a home in order for that computerized automated system to say, yes, we're going to give this person, an approval, right? Or maybe that person doesn't need reserves if they have a solid debt to income ratio or, an above average credit score. So the answer is it kind of depends if somebody needs those reserves or not. It's based on a profile as a whole, which typically would determine if reserves are necessary in that person's situation in order to get an approval.
Gotcha, gotcha. Okay, so it's not just credit strictly. They're looking at their total picture to
Correct.
seeing if they need the reserves or not.
Correct. The only difference to that are some lower credit score programs do require reserves, whether it works or not. Okay.
Okay. All right. All right. Okay. Gotcha. So if you are getting some down payment assistance programs, they're going to require you to have a certain amount of reserves.
In some lower credit score situations, yes, that's the case.
Okay. Gotcha. Gotcha. Okay. Okay. All right. Makes sense. Definitely makes sense. Okay. All right. So that was number five. Number six is how much of a down payment do I need, and are there options available for those who cannot afford a large down payment?
Yeah, so believe it or not, the biggest misconception still is sometimes, hey, do I need 20% to buy a
Mhm.
house? And the answer is no, and it quite frankly hasn't been that way in a long time, but it's just amazing how that myth is still out there. So for, a VA loan like I talked about, we could do 100% financing. For an FHA loan, we could do as low as 3.5% down. And for a conventional first-time home buyer, we could do as little as 3% down. So there's no and minimum down payment options for the three big major loans that exist. And then on top of that, there's things like down payment assistance, like local grant programs or lender grant programs like we have. So even though there's still a percentage that you may need down and some money that you may need to cover closing costs, there are some things to help subsidize that through the down payment assistance and local grant programs.
Listen, this is homes for everybody. You get a home, you get a home, you get a home. This
Mhm.
is homes for everybody. That's why it's imperative that if you're looking to buy a home this year or next year, or you're looking to upgrade, maybe you're in a house that's too small and you're looking to upgrade, it's imperative that you sign up. You go to www.buyinginphilly.com and you sign up for this ultimate home buying mastermind. We're doing pre approvals on the spot. So if you come down there and you want to get a pre-approval, we're talking to everybody, okay? Don't let anything hold you back. Even if you're just coming to get information, okay? Even if you're coming to get information, again, we're going to be at again, it's March 9th, which is in less than 2 weeks. We're starting at 1 o'clock. And it's just going to be a good time, a bunch of nice people, uh, information, and also, but at the end of the day, we want to get you guys in a home, okay? So let's go to number six. Number six is can you explain the importance of loan to value ratio and how it affects my mortgage?
Yeah, so the loan to value ratio is based on really what your down payment is. Okay. So I'll start with the VA loan because that's going to be a great example to kind of talk through what a loan to value ratio is. So with a VA loan, if somebody's putting zero down and borrowing 100% of the property value, that loan to value ratio is 100%, meaning they're borrowing 100% of whatever that purchase price is. So on the flip side, if somebody's putting 20% down, okay, so let's pretend we have a $100,000 home and somebody's going to do 20% down, they're now borrowing 80% of that home price, right? So that's an 80 LTV, which stands for 80 loan to value ratio. So that's how that works. And the lower the LTV, the easier it is to get approved, which means the higher the down payment for a situation, the more likely somebody would be to get approved for a mortgage.
Okay. All right. Sounds good. Sounds good. So you guys, that should be, I mean, that should be a question that you ask as far as what's your loan to value ratio. So you know how much of the loan, how much of the purchase price is the bank or mortgage company giving you? Because you're going to have to come up with the rest of it. Okay, the rest of that money is going to have to come from you or some type of down payment assistance program. So that was a good answer. Okay, next is how long will the loan process take, and what factors could delay the approval?
No, so that's a great question, and somebody can probably pick up the best tips, for something like this in the form of an answer. So once an offer gets, so I mean, we kind of like strategize together, right? So Khalid, if we're working together, right, and we pre-approve somebody and we go under agreement to purchase a home, usually what happens is we communicate. We say, hey, when does the buyer want to close, and what can we offer to the seller that's going to make it the most attractive offer to the seller, and sometimes sellers want to close relatively quickly, right? So I feel like the industry standard right now is to close within like a 30-day time frame, which gives us like, more than enough time from a mortgage standpoint to send out a formal mortgage application to a customer, maybe update a couple documents that we need for a formal loan approval, get an appraisal done, have a title company get back a title policy in enough time for a closing, as well as proper tax certifications being made in time for closing. So I would say like a 30-day time frame is relatively normal. And things that would jeopardize that 30-day settlement could be if a loan applicant maybe changes jobs mid-process and didn't tell us about it, even though we always share with people, hey, make sure if there's any changes to your situation, please let us know so we can help navigate the ship and adjust things accordingly. So there's no crazy things that come up. The other thing, believe it or not, is when we talk to people, we like to tell them whatever you do, please don't deposit cash into your bank account. So cash you really can't verify where the original source is. So we mortgage companies, we typically don't count cash as part of the money that you have in your bank account because we can't verify from whatever that original source is. So the two big things that I would say, hey, please don't do this, during loan approval, or talk to your mortgage consultant so we can figure out ways around this, would be no change in job and no large cash deposits into your bank account.
All right, guys. So that those thousands of dollars that you have under your mattress, don't just put them into the bank, okay? But I will give you guys a little secret. I'm gonna have Alex turn his speakers off real fast.
I'll put
If
my
you put
earmuffs on.
there you go. If you put the cash in your bank 3 months prior, then they're not going to look back that far. They may get some banks will ask for 1 month of bank statements, some will ask for two, some ask for three. But if they see that cash in there and they see it in there like stable, like not coming in, but it's already been in there, then they won't ask where it came from. Okay, so that's just a small tip for you guys. All right. So winding on down here, Alex, what happens if someone misses a mortgage payment, and what are the options for financial hardship?
Yeah, so all mortgages are doing the first of the month, okay? So everybody always has up to the 15th of the month to get their payment in before they're assessed any kind of late penalties. And then after the 15th, up until the very first day of the next month, it wouldn't be considered late per a credit report. You would just pay a late fee to your mortgage servicer. But if you let the payment go to the next month, that's when it'll A, hit your credit and damage your score, and then B, also have the late penalties on top of that. So it's like a little bit of a double whammy there. So, if you're having a tough time being able to afford your mortgage, your best option always is to call your loan servicer to see what kind of options they have available through hardship. And oftentimes, I can't tell you countless amount of times I'll do mortgages for people that have been in loan modification programs in the past, where mortgage servicer was willing to work with customer who couldn't really afford mortgage payments, so they alter the original terms and conditions of the loan, make it more affordable, and everybody wins in that situation.
Right, because the company wants to make money. At the end of the day, they're in business to make money, not to foreclose on you and got to go through the court and pay the lawyers and so on and so forth. So it's like, hey, if you're in financial difficulty, and this goes for homes or anybody that you owe, reach out to them and see if there's something that can be done, some type of payment plan that can be done versus just saying, oh, the heck with it and moving on and doing something else. So um, definitely appreciate that answer. And last question is here. Are there any incentives or first-time homebuyer programs that we should be aware of?
Yeah, there's so many right now. I feel like this is the year of the first time home buyers and then the grants. There's so many that exist right now, especially in Philly. I mean, Philly has an up to $10,000 grant. Um, there's also a local grant through the Urban League that we're doing a lot of, which is an extra 2,000. We at Prosperity, we're giving up to $10,000 grants in certain situations where people are eligible through either A, where they live, or B, where they're going to buy in based on census tracts. We do a lot of down payment assistance through the Pennsylvania Housing Finance Agency. So, like when people call and say, hey, what are your rates? And I want an FHA mortgage. They also say, hey, what kind of first time home buyer programs do you have? And there's so many of them that I kind of use the blanket statement that, like, listen, we have a bunch, but they all have different criteria. Some have credit score requirements, some have income limits, some have first time home buyer requirements, some don't. There's so many requirements with everyone, so it's kind of my job to take all the information, assess what your comfort levels are, see what kind of money you have available, and then come back to you and discuss what types of down payment assistance, grants, lender assistance that would be available for your particular situation.
Right. And that's why it's important to work with somebody like us who are knowledgeable about the down payment assistance program arena, because this is not something where you can go to one website and see all the down payment assistance programs in Philadelphia, New Jersey, and Delaware. No, it's like if you know, you know. If you don't, you don't. Okay, and it's something that me and Alex work with every day. Okay, so again, that's why it's important that to clear your schedules for March 9th. Again, we're 2 weeks out. Okay, a little under 2 weeks out. Clear your schedule for March 9th. Alex will be one of the featured speakers there. And again, everybody's going to get a customized home buying blueprint. We're going to talk about the entire home buying process. He dropped a lot of home buying gems tonight, but he's going to drop more that day. And if you're looking to get a pre-approval, we're giving out pre-approvals on the spot. 1 o'clock. Again, food, drink, door prizes, raffles. Just going to be a good time. So again, if you want to RSVP for that, you want to go to www.buyinginphilly.com. All right, Alex, we're going to close with this, man. If somebody wanted to buy a home and there was one thing that you had to tell them, what would it be?
Contact a mortgage professional as soon as possible. And here's why. I have people that call me and say, hey, I'm not looking for another 6 months, 12 months. I think it's too early. And I say it's never too early because don't you wish if you had 6 months to improve your situation that we took advantage of that now versus wait 6 months when it's time to buy a home? And here I could have given you tips to improve your situation and get you into a better program or a better interest rate opportunity. So I would always say, honestly, act fast because it's never too early to game plan for your future.
Awesome. And guys on TikTok, if you didn't hear that, what Alex said, if there's one thing that he would tell somebody that's wanting to buy a home, that's to contact a mortgage professional ASAP. Okay, because even if you're not ready, and I talk to a lot of people. Well, my lease isn't up for 6 months. My lease, I just re-signed a new lease. Okay, great. Now you got 12 months to put yourself in the best position to buy a home, but you're not the expert. Okay, so how would you know what to do? What they say, people don't know what they don't know. So if you contact somebody like Alex, a mortgage consultant, and find out what your situation is, yes, we're going to have to run your credit. We're going to have to run your credit, but it's not the end of the world. Hard pulls are only 10% of your credit score. Okay, your credit goes down 2 points, 3 points. Okay, don't worry. In that year time, it will be back as long as you don't do anything crazy. Okay, but um, but contact him first so he can see your situation and tell you, okay, how do we improve it? So come 12 months down the line, again, what's the biggest indicator of your interest rate? Is your credit score. So he's going to show you things and tell you different tips on how to build your credit score, or what your credit profile looks like right now, and look to improve it, man. Alex, why don't you tell them where they can find you?
Yeah, absolutely. My everything number, my cell phone number, 267-303-3368, or alexonlineapplication.com.
Awesome, awesome, man. And if for some reason, okay, that escaped you, you can always contact me and I'll get you in contact with Alex, and all of his information will be in the description. So, all right, y'all, we are out. But again, don't forget, March 9th, sign up right now. The Ultimate Home Buying Masterclass. Again, it's going to be at 1 o'clock. We're going to give you customized home buying blueprints. You'll know the whole home buying process. You'll get a credit boost, home inspection tips, down payment explanation with also grants, um, insurance review, and again, we're doing pre-approvals on the spot. All right, y'all. This is Colin Nathan Alim, the real estate boy. If you're looking to buy home, sell home, or invest in real estate, I got you. All right, y'all.